Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Fontaine. Brandon is a vice president and research associate on the economics and fixed income research teams. Brandon, how are you doing today?
I'm doing great, Ross. How about yourself?
Doing well, thanks. I love talking to you because we get to talk about the manufacturing sector, which is less discussed. We recently got some new manufacturing data, both the ISM PMI and Strategas' proprietary SLIM reading. What are those two things telling you about the manufacturing environment today?
Yeah, so the ISM PMI fell to 48.7 in May. And what that reading means is that the US manufacturing environment is in contraction. A reading below 50 means contraction, and a reading above 50 means expansion. What was the primary driver of the contraction in the ISM PMI was a fairly weak new orders print. The two largest negative contributors in May were new orders and inventories, while you did see employment and production offer positive contributions to the headline number. Obviously, it netted out to be a negative 48.7, which was a weaker than consensus print. In terms of our own proprietary measures, our SLIM survey new orders index fell to 53.8 in May. Now that means the expansion, or it means the manufacturing environment is still in expansion, but at a slower pace than we saw in April. Our supply deliveries index remained unchanged at 50. Now, when we talk to participants in conversations with them and from the comment section from our SLIM survey, we can glean that the manufacturing environment has improved from last year, though high interest rates continue to cause some choppiness in the overall growth. Now, there are still tailwinds for the sector for the rest of the year. One of those is the implementation of previously passed industrial policy, and I think that's going to continue to play a role not only for the rest of this year, but in years to come.
Yeah, let's talk about that. Mixed manufacturing environment, as you mentioned, but a lot of talk about reshoring, onshoring, critical supply chains, a lot of fiscal spend going towards those areas. So what are you seeing on that front? Obviously, it could be a tailwind going forward. Are you seeing those dollars being put to work? Are you seeing manufacturing activity as a result of that previously passed policy?
Yeah, so I'd break those up into two parts. One, the spend going into manufacturing, and two, the impact of it. So if you look at a chart of non-residential construction spending, you'll see manufacturing construction has surged. The primary driver of that is computer and electronic production. And that's the CHIPS Act, that's the government policy, the industrial policy money going to work in terms of building out new facilities. But you haven't seen really those facilities begin to come online yet. Manufacturing production has been largely flat for a decade, and manufacturing employment is mostly flat as well. So despite the fact that you've seen a large sum of money pour into construction, that hasn't yet translated into construction that has yet to translate into physical production of goods.
Gotcha. So moving from a tailwind for the sector to a potential headwind, we actually talked to you about this last time you were on, which is supply chain disruption by way of issues in shipping and freight, both geopolitical in the Suez Canal and potentially drought related in the Panama Canal. What are you seeing on that front in the supply chain readings and its potential to be inflationary in the back half of 2024 or potentially for a longer period of time?
So first, I'll touch on the Panama Canal. And rainy season has begun in Panama, which has lifted canal levels and allowed for more ships to pass through. And on the Suez Canal front, you really haven't seen any real uptick there. With the Houthi attacks on ships, the traffic remains depressed. Now, despite the fact that you've seen what could cause an increase in delivery times in terms of less thoroughfare through the Panama Canal and less traffic through the Red Sea and Suez Canal, that hasn't translated to an impact in bottlenecks. Our supply deliveries index which has a 90% correlation with the ISM supply deliveries index, remained unchanged at 50. And if we look at other measures like the New York Fed Supply Chain Pressure Index, that also isn't showing signs of stress at all. Now, where we're seeing some concern is freight rates. Due to a global container shortage, you've seen freight rates really begin to surge higher in recent weeks. Those are fairly strongly correlated with goods inflation, not just in the US, but in Europe, in China. There's a strong relationship between freight rates and goods prices globally. So the uptick there is particularly concerning to us. Now, we have not seen any evidence that that's bleeding into inflation data yet, but with the Fed nearing the first cut, we believe that's going to be in September, it's worth watching.
Yeah, absolutely worth watching. As y'all have showed in the past, inflation does tend to come in waves. So we're being on the lookout for that second wave. Brandon, I want to thank you so much for the time today, and we'll look forward to the chance to get to talk to you again soon.
Thank you, Ross. Have a great day.